What we're witnessing right now in the Caribbean isn't just another regional conflict. This is a fundamental restructuring of global economic power that will have cascading effects across energy markets, currency systems, and trade relationships for decades to come. And frankly, most analysts are missing the bigger picture entirely. Let me start with what's actually happening on the ground, because the military movements tell us everything we need to know about the economic stakes involved. The United States has deployed over 12,000 troops on nearly a dozen naval vessels to Venezuelan waters. The USS Gerald R. Ford, the world's largest aircraft carrier, arrived in the Caribbean Sea on November 15th. This isn't a show of force. This is a blockade in everything but name. And blockades have one purpose: economic strangulation. Now, why does this matter? Venezuela sits on the largest proven oil reserves in the world. We're talking about 303.8 billion barrels. That's more than Saudi Arabia, more than Canada, more than Russia. And for context, that represents roughly 18% of global proven reserves. But here's where it gets interesting. From an economic standpoint, Venezuela's oil production has collapsed from 5 million barrels per day in the late 1990s to barely 700,000 barrels per day today. That's an 80% decline in production capacity. The Trump administration just terminated Chevron's permit to export Venezuelan oil on November 24, 2025. This was the last remaining legal channel for Venezuelan crude to reach international markets. Chevron had been the lifeline keeping what remained of Venezuela's oil infrastructure operational. Without their technical expertise and capital investment, we're looking at further production declines of potentially 30 to 40% within the next 12 months. But Trump didn't stop there. He imposed a 25% tariff on all goods imported from any country that imports Venezuelan oil. Think about the implications of that for a moment. This isn't just sanctioning Venezuela. This is sanctioning anyone who does business with Venezuela. India and China have been the primary buyers of Venezuelan crude in recent years, taking advantage of steep discounts. India was importing roughly 200,000 barrels per day of Venezuelan oil. China was taking even more, around 400,000 barrels daily. Now, here's where the economic dominoes start falling. India relies on imported oil for 85% of its consumption. Chinese demand for oil sits at roughly 15 million barrels per day, with domestic production covering only about 4 million. Both economies are heavily dependent on affordable energy imports to maintain their manufacturing competitiveness. If they comply with American pressure and stop buying Venezuelan oil, they need to find alternative suppliers. That means bidding up prices in an already tight global oil market. If they don't comply and continue purchasing Venezuelan crude, they face a 25% tariff on all exports to the United States. For India, the U.S. represents roughly 18% of total exports, worth over $78 billion annually. For China, we are talking about 16% of exports valued at more than $500 billion. The economic calculus here is brutal. Either accept higher energy costs that reduce manufacturing competitiveness, or accept massive tariffs that price you out of the American market. This is economic warfare at a scale we haven't seen since the 1970s oil embargo. And it's happening right now. Let's talk about what this means for global oil prices. Brent crude is currently trading around $87 per barrel. West Texas Intermediate is at $83. These prices reflect a market that's already relatively tight. Global spare capacity, the amount of oil that can be brought online within 30 days and sustained for 90 days, currently sits at around 3 million barrels per day. That's roughly 3% of global demand. Historically, when spare capacity falls below 5%, we see significant price volatility. If Venezuelan production drops another 300,000 barrels per day due to the loss of Chevron's technical support and expertise, and if India and China are forced to compete for alternative supplies, we could easily see oil prices spike to $120 to $140 per barrel within 6 to 9 months. Every $10 increase in oil prices reduces global GDP growth by approximately 0.2 percentage points. A sustained move to $130 oil would shave nearly 1 full percentage point off global growth. For the United States specifically, higher oil prices act as a massive regressive tax on consumers. Every 1 cent increase in gasoline prices represents roughly $1. $4 billion in additional annual consumer spending on fuel. If we're looking at crude oil moving from $80 to $130 per barrel, retail gasoline prices could jump from the current national average of $3.30 per gallon to somewhere north of $5 per gallon. That's an additional $250 to $300 billion coming out of American consumer spending on gasoline alone. But energy prices are just the beginning. Let's examine what happens when you deploy 12,000 troops and a carrier strike group indefinitely to the Caribbean. The operational cost of running a carrier strike group is roughly $6.5 million per day. That's $2.4 billion per year, just for the Ford strike group. But we're not talking about one carrier. The U.S. has deployed nearly a dozen naval vessels to the region. The total cost of this military deployment is likely running between $8 and $10 million per day, or roughly $3 billion annually if sustained. Now let's talk about the elephant in the room, Russia. On October 27, 2025, Putin ratified a strategic partnership treaty with Venezuela. This isn't just diplomatic posturing. Russian lawmakers have stated explicitly that there are no obstacles to providing Ornik or Caliber missiles to Venezuela. The Oreshnik intermediate-range ballistic missile has a reported maximum range of about 3,400 miles. That's enough to reach most of the continental United States from Venezuelan territory. Why would Russia take this risk? Because Venezuela represents a strategic economic asset in Russia's broader confrontation with the West. Russian oil exports have already been heavily sanctioned since the invasion of Ukraine. Urals crude, the Russian benchmark, has been trading at significant discounts to Brent, typically $15 to $20 per barrel, below international prices. Russia has been forced to redirect its oil exports almost entirely to Asia, particularly India and China. If the United States successfully chokes off Venezuelan oil supplies and forces India and China to find alternatives, Russia becomes one of the most logical suppliers to fill that gap. Despite sanctions, Russian oil production has remained relatively stable at around 9.5 million barrels per day. They have the capacity to increase exports if there's demand. By supporting Venezuela militarily, Russia accomplishes multiple objectives simultaneously. First, it ties down American military resources in the Western Hemisphere. Second, it creates leverage in ongoing negotiations over Ukraine. Third, it positions Russia as a critical energy supplier to the world's largest growth markets. Think about this from China's perspective. China imported roughly 11 million barrels per day of crude oil in 2024. They've been diversifying away from Middle Eastern suppliers for years, increasing purchases from Russia, Venezuela, Iran, and other sanctioned producers. Why? Because sanctioned oil comes with steep discounts. Venezuelan crude has been selling for $30 to $40 per barrel below Brent prices. That's a savings of roughly $150 million per day for China on the 400,000 barrels they've been importing from Venezuela. But there's a deeper strategic consideration. China holds over $800 billion in U.S. Treasury securities. If the United States imposes a 25% tariff on all Chinese goods because China continues buying Venezuelan oil, what's China's response? They could dump treasuries, driving up U.S. borrowing costs. They could devalue the yuan, making their exports more competitive despite tariffs. They could accelerate the internationalization of the yuan as an alternative to dollar-based trade. This last point is crucial. For decades, oil has been priced and traded primarily in U.S. dollars. This gives the United States enormous structural power in the global economy. Countries need dollars to buy oil, which means they need to hold dollar reserves, which means they buy U.S. Treasury securities, which allows the U.S. to run massive deficits without facing the same constraints other countries would face. But what happens when sanctioned producers like Russia, Venezuela, and Iran start accepting yuan for oil? China has been pushing for exactly this arrangement for years. Russia has already shifted significant portions of its trade with China to yuan settlement. If Venezuelan oil starts trading in yuan and if Indian purchases from Russia expand in rupee-ruble arrangements, we are looking at the beginning of a genuine alternative to the petrodollar system. The economic implications are staggering. The dollar currently represents roughly 59% of global foreign exchange reserves. If that share drops to 50% over the next decade, it means central banks worldwide are holding $600 billion less in U.S. assets. That's $600 billion of demand for treasuries that evaporates. In a market where the U.S. needs to borrow nearly $2 trillion annually just to cover the deficit, losing even 10% of foreign demand would push interest rates significantly higher. Let's run through a scenario. Current 10-year treasury yields are around 4.4%. If foreign demand for treasuries drops by 10 to 15% due to dollarization pressures, yields could rise to 5 or 6%. Every 1 percentage point increase in the 10-year yield adds roughly $400 billion to federal interest costs over a decade. we're talking about an additional cost of 500 to 600 billion in debt servicing. And that's before we consider domestic economic impacts. Higher treasury yields mean higher mortgage rates, higher corporate borrowing costs, higher state and local government financing costs. The 30-year fixed mortgage rate, currently around 7%, could push toward 8 to 8.5%. That effectively freezes the housing market as potential buyers are priced out. And existing homeowners with 3 to 4% mortgages from a few years ago have no incentive to sell and trade up to much higher rates. Now, let's circle back to Venezuela and the immediate crisis. The Trump administration designated Maduro and Venezuelan government officials as members of the Cartel de Luz's foreign terrorist organization on November 24th. This is an escalation with profound economic consequences. When you designate a government as a terrorist organization, you criminalize not just government-to-government relations, but any economic activity that might benefit that government. That means any company anywhere in the world that does business with Venezuela could potentially face prosecution under U.S. law for material support of terrorism. Think about the chilling effect on trade. Venezuela imported roughly $12 billion worth of goods in 2023. Most of that came from China, Turkey, Brazil, and European suppliers. If those companies face potential criminal liability for continued trade, Venezuela's import capacity collapses even further. Venezuela's economy has already contracted by approximately 75% since 2013. GDP fell from $337 billion to roughly $97 billion. This is economic collapse on a scale rarely seen outside of major wars. Hyperinflation peaked at over 1,000,000% in 2019 before dollarization brought some stability. But with imports collapsing and the oil sector facing further decline, we could see renewed inflationary spirals. When economies collapse this severely, you get migration. Venezuela has already experienced the largest refugee crisis in Western Hemisphere history, with over 7.7 million people fleeing the country since 2014. That's more than 1/4 of the population. If economic conditions deteriorate further, we could see another 2 to 3 million people attempting to leave. Where do they go? Colombia has already absorbed 2.9 million Venezuelan refugees. Panama has become a major transit route for migrants heading north through the Darien Gap. Mexico is seeing increased flows, and ultimately, many are heading to the United States. The economic cost of this migration is enormous, both for host countries providing services and for Venezuela losing its most productive population. Let's talk about what military conflict would actually mean economically. If the United States conducts strikes against Venezuelan military targets or attempts a broader intervention, oil markets would go into panic mode immediately. We saw this during the Gulf War in 1990 to 91, when oil prices spiked from $20 to $40 per barrel in a matter of weeks. We saw it again briefly in 2003 with the Iraq invasion. A military conflict involving Venezuela would be different because of Venezuela's strategic location. The Caribbean is a crucial transit route for global commerce. Approximately 12% of global seaborne oil trade passes through the Caribbean. 15% of U.S. petroleum imports transit through the region. If that route becomes a conflict zone, insurance rates for shipping spike dramatically. We're talking about increases from current rates of around 0.1% of cargo value to potentially 2 to 3% of cargo value. In a conflict zone, that might not sound like much, but when you're shipping 500,000 barrels of oil worth $43 million at current prices, a 2% insurance premium adds nearly $900,000 to the cost. That gets passed directly to consumers. Shipping costs from the Gulf of Mexico to East Coast refineries could double or triple overnight. Venezuela has 21 operational Su-30 fighters that can be armed with supersonic KH-31A anti-ship missiles. These missiles have a range of about 160 kilometers and are specifically designed to target naval vessels. Venezuela also reportedly now has Russian PANS-1 and Buk M2E air defense systems. If Russia provides more advanced missile systems like the Caliber cruise missile, which has a range of 2,500 kilometers, suddenly every U.S. Navy vessel in the Caribbean is potentially at risk. The USS Gerald R. Ford carries over 4,500 sailors. A Ford-class carrier costs $13.3 billion to build. Losing even one major naval vessel in this conflict would be an economic and strategic catastrophe beyond measure. The risk premium on such an engagement is enormous, which is precisely why Venezuela and Russia are emphasizing these capabilities. They're trying to make the cost of intervention prohibitively high. From a game theory perspective, both sides are locked in a commitment problem. The Trump administration has deployed massive military resources and issued ultimatums. Backing down now would be seen as weakness, potentially emboldening rivals elsewhere. But Venezuela, supported by Russia, has its own credibility on the line. If they capitulate to U.S. pressure, Maduro's government likely falls and Russia loses a strategic foothold in the Western Hemisphere. This is where economics and strategy become inseparable. The current standoff is consuming roughly $10 million per day in direct military costs for the United States. That's $3.7 billion annually. But the indirect costs, higher oil prices, reduced trade, increased migration, are likely 10 to 20 times higher. We could easily be looking at $40 to $70 billion in total economic impact annually if this situation continues, and it will continue because neither side can afford to back down without achieving their core objectives. The United States wants regime change in Venezuela, or at minimum, a complete reorientation of Venezuelan foreign policy away from Russia and China. Venezuela wants survival, sanctions relief, and access to international markets for its oil. Russia wants to maintain its strategic partnership and use Venezuela as leverage in broader negotiations over Ukraine and European security. China wants stable energy supplies at reasonable prices and doesn't particularly care who governs Venezuela as long as the oil keeps flowing. India finds itself caught in the middle, trying to balance its growing strategic partnership with the United States against its desperate need for affordable energy to fuel economic growth. Let's examine what the endgame scenarios look like economically. Scenario 1. The United States successfully pressures regime change in Venezuela through a combination of military pressure, economic sanctions, and support for opposition forces. A new government comes to power, normalizes relations with Washington, and begins the long process of rebuilding the oil sector with American and European investment. In this scenario, Venezuelan oil production could potentially recover to 2 to 2.5 million barrels per day within 5 to 7 years. That additional 1.5 million barrels per day would represent a meaningful increase in global supply, potentially bringing prices down by $10 to $15 per barrel in the medium term. The U.S. gets a friendly government in Caracas. Russian influence is expelled from the Western Hemisphere, and American energy companies get access to the world's largest oil reserves. But here's the problem. Rebuilding Venezuela's oil infrastructure would require between 100 and 200 billion in investment over a decade. Given the political risk, investors would demand risk premiums of 10 to 15% returns. At current oil prices, that might be achievable. They're trying to make the cost of intervention prohibitively high. From a game theory perspective, both sides are locked in a commitment problem. The Trump administration has deployed massive military resources and issued ultimatums. Backing down now would be seen as weakness, potentially emboldening rivals elsewhere. But Venezuela, supported by Russia, has its own credibility on the line. If they capitulate to U.S. pressure, Maduro's government likely falls and Russia loses a strategic foothold in the Western Hemisphere. This is where economics and strategy become inseparable. The current standoff is consuming roughly $10 million per day in direct military costs for the United States. That's $3.7 billion annually. But the indirect costs, higher oil prices, reduced trade, increased migration, are likely 10 to 20 times higher. We could easily be looking at $40 to $70 billion in total economic impact annually if this situation continues, and it will continue because neither side can afford to back down without achieving their core objectives. The United States wants regime change in Venezuela, or at minimum, a complete reorientation of Venezuelan foreign policy away from Russia and China. Venezuela wants survival, sanctions relief, and access to international markets for its oil. Russia wants to maintain its strategic partnership and use Venezuela as leverage in broader negotiations over Ukraine and European security. China wants stable energy supplies at reasonable prices and doesn't particularly care who governs Venezuela as long as the oil keeps flowing. India finds itself caught in the middle, trying to balance its growing strategic partnership with the United States against its desperate need for affordable energy to fuel economic growth. Let's examine what the endgame scenarios look like economically. Scenario 1. The United States successfully pressures regime change in Venezuela through a combination of military pressure, economic sanctions, and support for opposition forces. A new government comes to power, normalizes relations with Washington, and begins the long process of rebuilding the oil sector with American and European investment. In this scenario, Venezuelan oil production could potentially recover to 2 to 2.5 million barrels per day within 5 to 7 years. That additional 1.5 million barrels per day would represent a meaningful increase in global supply, potentially bringing prices down by $10 to $15 per barrel in the medium term. The U.S. gets a friendly government in Caracas. Russian influence is expelled from the Western Hemisphere, and American energy companies get access to the world's largest oil reserves. But here's the problem. Rebuilding Venezuela's oil infrastructure would require between 100 and 200 billion in investment over a decade. Given the political risk, investors would demand risk premiums of 10 to 15% returns. At current oil prices, that might be achievable. But if oil transitions to a structurally lower price environment due to increasing renewable energy adoption, as many predict, those investments don't make economic sense. Scenario 2, the current standoff continues indefinitely, becoming a frozen conflict, similar to the situation with Cuba for decades. Sanctions remain in place. Venezuelan oil production continues declining, and the country becomes increasingly dependent on Russia and China for economic survival. In this scenario, we're looking at sustained higher oil prices, continued migration flows, and ongoing military expenditures for the United States. The economic drag on the U.S. economy would be persistent but manageable, perhaps 0.2 to 0.3 percentage points of GDP growth annually. However, the cumulative cost over a decade would be substantial, potentially 500 billion to 700 billion in lost growth. Russia and China strengthen their position in Latin America, and the trend toward the dollarization accelerates as more countries seek to avoid being caught in similar sanctions regimes. Scenario 3. Military escalation. The United States conducts broader strikes against Venezuelan military infrastructure or attempts a limited intervention. Venezuela, with Russian support, retaliates against U.S. naval vessels or regional allies. The conflict escalates into a broader regional war involving Colombia, Brazil, and potentially other actors. This is the nightmare scenario economically. Oil prices spike to $150 to $200 per barrel. Global growth contracts by 2 to 3 percentage points. The U.S. faces simultaneous challenges in Europe with Ukraine, in the Middle East, and now in Latin America, overstretching military resources. The federal budget deficit explodes to 2.5 to 3 trillion annually as military spending surges and economic growth collapses. Realistically, I assess scenario 2 as most likely. Neither side wants full-scale war, but neither can back down without unacceptable losses. We're heading toward a protracted economic siege of Venezuela, with Russia and China providing enough support to prevent total collapse, but not enough to restore prosperity. The Caribbean becomes another zone of great power competition, with all the associated costs and risks. For global markets, this means several things. First, oil volatility is here to stay. Any resolution of this crisis is years away, which means the risk premium on oil prices remains elevated. Energy-intensive industries need to plan for sustained higher costs. Second, the de-dollarization trend accelerates. More countries will seek alternatives to dollar-based trade to reduce vulnerability to U.S. sanctions. Third, defense spending globally increases as countries observe that economic interdependence didn't prevent great power competition. It just changed the battlefield. The broader lesson here is that we've entered an era where economic policy and military strategy are completely fused. Sanctions are weapons. Trade policies are tactics. Currency systems are strategic assets. The post-Cold War assumption that economic integration would reduce conflict has been proven wrong. Instead, economic integration created vulnerabilities that can be exploited. And we are watching that exploitation happen in real time off the coast of Venezuela. For investors, this environment demands a fundamental reassessment of risk. Geographic diversification isn't enough. When conflicts can disrupt global supply chains, currency diversification becomes essential when the dollar's role is being challenged. Energy security transitions from a nice-to-have to a critical requirement for any major economy. The Venezuela crisis is a preview of the conflicts to come. As climate change disrupts agriculture, as water resources become scarce, as critical minerals for technology become strategic assets, we'll see more situations where economic interests and military power intersect. The cost of these conflicts, measured in reduced growth, higher defense spending, and lost opportunities for cooperation, will be measured in the trillions. What we are witnessing isn't just about Venezuela, it's about the rules of the global economic system being rewritten through confrontation rather than negotiation. And that process, regardless of how it resolves in this particular case, will define the economic landscape for decades to come.